This meeting is being recorded.
We understand what is the time value of money. Okay. We also understand what are the different types of bonds. Okay, we understand that is some of the types of bonds. That is the coupon bonds, uh, zero coupon bonds, callable bonds. Okay, we also understand how the bond prices move. What is the impact of interest rates on the we can say bond prices. We also understand the very basic concept that is the time value of money, because we know that um, in equity shares or in bonds, okay, so they are always the future cash flows associated with two of these. Okay, whenever we invest in a bond, okay, so we will get the interest on the bonds. That is all the monthly installments we are receiving as investors, which is we can say all these cash flows are the futures cash flows. Okay, so in time value of money, we actually calculate the value of the money according to the purchasing power of the money actually. So based on that, we know the we can say the present value and we calculate the future value. That means numeric we can say mathematically, numerically, we can say the 100 rupees in 2025 and 100 rupees in 2030, they looks same, yeah, mathematically or numerically we can say these two values are similar. Okay, but yeah, in financial terms, we cannot say that the 100 rupees in 2025 and 100 rupees in 2030 are same, because of the time value of money. As time goes, the purchasing power of the money gets decreases because of the inflation effect in the economy. So that same concept we considered in the while doing the valuations of bonds and the valuations of the equity shares. Okay, so first we understand how. Now we know whenever we can say invest in a bonds. Okay, so the two types of future cash flows there in the bonds. First one is we can say the monthly installments, or we can say the quarterly installments, or the 6 months installments. So whatever the decided between the two parties, that is the loan giver and the loan taker. Okay, so these future cash flows they mutually decides, and at the maturity of the bond, okay, so the who loan giver gives the we can say the principal amount to the we can say the loan giver. Okay, so that means these are the two types of cash flows. That is, we can say the installments, and next one is we can say the principal amount. So these are the two types of future cash flows. For example, if I take that the I have the 10 lakh rupees, I give this 10 lakh rupees on a loan to any company. So what company will do? Company will pay the installments to me on a monthly basis, and after the 10 years, okay, company pay a one principal amount of that loan to me. That means these monthly installments and the principal amount, these are the two types of the cash flows we found in the bonds. Okay, so how the value of the bond, the present value of the bond that we calculated. So there is a formula to calculate the present value of the bond. Okay, so in this formula, we can say take the effects of both the things. That is, the C is the coupon payment. Coupon payment means the we can say the installments payment. So you can pay the coupon on a monthly basis, on a quarterly basis, on a 6 monthly basis, or a yearly basis. Okay, so what the two parties mutually decides, how they make the payments. Based on that, they decide the value of the coupon payment. And next one is the we can the face value F. Okay, so if you see the formula, that so the present value of the bond is the actually a summation of these two. That is the, we can say, we first we take the effect of the coupon payments, so that's the present value of bond is equal to summation of T21 to T. That means whatever the maturity period. So small t represent the, we can say, one means the first year, and the we can say the capital T shows the maturity period. Okay, the maturity period may be a could be any what the maturity decides. It may be a 5 years, 10 years, 15 years, 20 years. Okay, so for that particular time of particular time, the company repays the coupon. Continuously, they have to pay the coupons, and at the maturity of that bond, now the company has to pay the face value to the, we can say, to the investor who gives the loan. Okay, so the these two effects, so P is equal to summation of T21 to T C divided by 1 plus R. R is the we can say the yield to maturity. So it is actually the, we can say, the discount rate. Raised to power, we can say a small t. So it is the summation actually, because every year we know the company is paying that coupon payment, that is the value of C, every year. So we take the summation of all this. Okay, but the next part of this formula is, we can say, the face value payment. So face value is actually paid by the loan taker at the end of the uh, maturity. That means the face value paid only at a once, at a one time. So that's why we cannot take any submission over here, because of it is not, we can say, a continuous payment. It is actually a one time payment. So we take the F divided by 1 plus R raised to power T. So this is how the value of the bond calculated, the present value of the bond calculated. So here the P is the present value of the bond. C is the coupon payment, that is the installment payments. R, we can say, the yield to maturity is actually the, we can say, the discount rate. Next, F is the face value at the maturity of that bond, how much principal amount will be returned by the, we can say, who takes the loan. And T is the periods of to maturity. Okay, what is the time periods, what is the maturity period of that bond. So this is how the value of the bonds calculated by using that formula. Okay, so for your better understanding, okay, how actually the valuation of the bonds is done, we will you guys can understand with this a small video, then you will have idea how actually the values are calculated.
Hey guys, I am Derek. Welcome to my channel. In this video, I'm going to show you how to do bond valuation. When we say valuation, it means we are calculating the price or value of an investment. This is a basic model or formula we use to calculate the price or the value of a bond. V0 is the bond price. Here we have to include two components. The first is coupon interest payment.
If you see in this formula, actually the formula which I showed you in the presentations, in which we take the summation sign, that is the summation of all years coupon payments. But actually here he not takes the summation sign. He actually he already takes the summation of all the cash inflows. That is for first year, he pay the coupon payments of C1. So he takes C1 divided by 1 plus I. I is the, we can say, the yield to maturity. That is the, we can say, the discount rate. This to power n. This payment is made on a first year. So that's why he take the value of 1 plus C2. C2 is the, we can say, in second year, he who takes the loan, he make the payments of, if the company make payment of the coupon payment of C2. So C2 divided by 1 plus I. I is the same discount rate. Now this is the second year. Okay, so this raised to power 2 plus same likewise C3. C3 will be the coupon payment in the third year divided by 1 plus I raised to power 3. If we can say the maturity period is 10 years, then we can say we do this same, we follow this formula for 10 years. That is the C4 divided by 1 plus I raised to power 3 plus, we can say, C5 divided by 1 plus I raised to power 5, C6 divided by 1 plus I raised to power 6, C7. So C7 is the coupon payment in the 7 years, uh, divided by 1 plus I raised to power 7. So we'll do for the 10 years. And here, if you see what he did, he write the par here, the par value. That is, it is the principal amount returned at the maturity of that bond. So that means that the principal amount will be he pay back after the maturity. That means after the 10 years. So that's why here in the presentations I show you, in this we take the EF, the par value we show with the phonation, we can say, with we show with the notion of F, here he writes the par, that is the principal amount that is repayable at the maturity of the bond. So that principal amount return after the 10 years. So that's why the par divided by, or F divided by 1 plus I raised to power n. N means the maturity period that we consider the 10 years. So this is how the formula, we can say, that returns here. Okay, so these both formulas are same, but in the presentation formula we take the summations. That means we can write it separately as well. Okay, so this is how the formula of the bond that gives us the price of a bond. Okay.
The second is the par value or the principal value of a bond, which is usually equal to $1,000. To get the price of a bond, we are basically converting all the future cash flows back to current year, year zero. In other words, the price of a bond is the same as the present value of all future cash flows. I is the discount rate, required rate, or market interest rate. N is the number of time period until maturity. Let's take an example. What is the market price of a $1,000 par value 20-year bond that pays 9.5% compounded annually when the market rate is 10%? Before I show you how to do the calculation, let's understand the meaning of this question first. $1,000 par value, this is the future value that you will receive at the end of the maturity date after 20 years of investment. This is also called the face value. 20-year bond represents the maximum period of this investment. After 20 years, this investment will come to maturity. 9.5% is the coupon interest rate. You will have to convert it into dollars by multiplying it with the par value. Therefore, your coupon interest payment is $95. Market interest rate is the current interest rate people receive in the market from similar investments. And this question is asking you to calculate the market price of this bond. Market price means the price.
So here one example is given. If you invest in the bond, that means you will get the $1,000 par value. That is, it is the face value of the bond. That means after 20 years, if you invest in a bond, you will get the face value of the $1,000. That means after 20 years, you have the cash inflow of the $1,000. Okay, and what is your, we can say the coupon payments, what you received annually. That means here, the installments are compounded annually. That means each year you will receive one certain amount on your bond. As we know that continuously interest investor received on a bond. Okay, so what is that? We can say the coupon payment or the interest payment. So here is given that is the 9.5 compounded annually on the face value. That means 1,000. If we convert the one, multiply the $1,000 by that 9.5, so we will get the 95 rupees coupon payment each and every year. Okay, and what is the market rate? Or we can say the discount rate. That is the 10%. That is the value of I. And with the help of that, we can calculate the, we can say the present value of the bond. Okay, so here if you see, that means here he in this chart, they already he shows that each and every year you receive the coupon payments of the 95 years. And year one, $95, year two, $95, year three, $95, and this continuously. So in 20 years, okay, we received the 95 coupon payment plus 1,000 face value. Okay, so these all are the future cash flows. Okay, so but we know these are the this the payment we will receive in a future. But what is the present value of all these future cash flows that we need to calculate by using our formula. So we'll see how the calculations are done.
Present value, PV. To calculate the market price of the bond, you need to use an app called Financial Calculator. You may download it from Google Play Store or Apple App Store. Financial Calculator. First, you need to set the compounding to annually. It means when you invest in this bond, you will receive the coupon interest payment once a year. Now, key in the face value or par value, FV, $1,000. Annual coupon payment, PMT, taking 9.5% times $1,000 face value, equals to 95. Annual yield, this is the market interest rate, IY, equals to 10. Years to maturity, N, equals to 20. Last step, just press price button, you will get the bond price, PV, negative $957.43. Negative sign means this is a payment. You pay $957.43 to purchase this bond investment. So that, every year you will receive coupon payment of $95 for 20 years. At the end of 20 years, you will get back $1,000 face value. Let's look at the next example, which is about semi-annual compounding. What is the market price? Let's look at the next example. Payment of.
Okay, so here the face value of the bond is the $1,000. So when we calculate the present value with that all the future cash flows of the $95 per year coupon payments and the face value of the $1,000 after the 20 years, we calculate the bond price present value is the $957. That means we purchase the bond and we provide the loans of $957 to the company, and the company gives me the coupon payments every year of the $95, and at the maturity of the 20, maturity of the bond, that means after the 20 years, the company will pay me the $1,000. So this is how the calculation of the bonds, we can say, we done. Okay, so here it is the annual compounding. We can calculate the same we can do the same calculations for the semi-annually, quarterly compounding, okay, for the monthly installments, okay. So by using these different compounding methods, we can calculate the value of the bond, that is the present value of the bond. So this is how the value of the bonds calculate by using the that formula, okay. Second. So we this is how the value of the bonds calculated by using that formula. Now we understand how the value of the shares. We know that the two are the most important investment avenues which is available to the investor. That is the bonds and shares. Okay. Now just to understand how the value of the bonds calculated. Okay. So we understand. We need to understand how the value of the shares also gets calculated. We know a share is the different investment from the bonds. Okay, so bonds are actually receives the coupon payments. Bonds are, we can say, whenever we invest in the bonds. Okay, so there will be the no ownership transfer in the bonds. Only we will receive the interest and the principal amount that we invested in the bonds. But share investment is the very different investments from the bonds. So shares are actually whenever we invest in a shares of the any organizations, that will gives you the ownership of that organizations of that company. Okay, so on shares we will not receive any interest. Okay, so we will not receive the principal amount. Okay, so there is a no maturity date in the share capital. That means you you never heard or you never see that I buy the shares and the maturity is the 10 years or the 15 years. Actually, whenever you buy shares of the any organizations, okay, you are now owners of that organization for the same proportion or the same percentage as you purchase the percentage of shares of that organizations or the company. Okay, so that means now you will enjoy the, we can say, the wealth of the organization if it's increase. All you may have the losses whenever the company is not doing financially well, because that you are the owner of the organization. Okay, so you have to we can say now you have to bear the losses as well as the owner of the organizations. Okay, so this is how we can say this is the concept behind the share capital. So share capital, how share capital gives the return to the investors. So the return given by the shares to the investor in two ways. First one is, we can say, the dividends. Okay, so whenever I invest in the any organization share capital, if the company is making the profit, so the profit is distributed among the shareholders. Okay, so I'll receive the dividend. So as the percentage of my shareholding in that company. Also, there is also the we can say whenever the company's growth at the certain rate, that means if the company's growth at grow at the 100%, automatically my wealth, my shares value will grow at the 100%. For example, if I invest the 1 lakh in Infosys, and the value, we can say, the wealth of the Infosys increase three times. So automatically my investments increased at the three times. That means my 1 lakh now will be the, we can say, the 3 lakhs. So this is how, that means that 2 lakhs is my return on my investment. If I received the 50,000 dividend as well in last um, uh, from the investment times, then my total return is the 2.5 lakh rupees. So this is how we calculate the return on the shares as well. So how we can say to actually to calculate the value of the shares, there are actually the three different approaches. First one is, we can say, the multiplier approach, that is the PIE approach. Okay, that means the profit earning approach. Okay, so how the shares are giving you the earnings. So next one is, we can say, the Horden growth model. Okay, so this model actually considers the how the growth of the organizations, growth of the companies gives you the return. On that basis, we calculate the present value of the shares or the value of the shares. Now, next one is, we can say, the dividend discount model. Okay, as I told you that the shares gives you the return in the form of the dividend as well. So this model actually consider the dividend as the return, and on that basis, uh, we calculate the value of the share. So these are the three different methods. Okay, in bonds we have only the one type of formula, and on that basis we calculate the value of the bonds. But in shares valuations, you have to follow you can calculate the value of the shares by using the three different approaches, that is the multiplier approach, PI, that is the profit earning approach, or we can say the Gordon model growth, Gordon growth model, and next one is the DDM, that is the dividend discount model. So first we understand how the multiplier model is calculate the value of the shares. Okay, just a second. So this is we first we understand how the Gordon growth models calculate the value of the shares. Okay,
Welcome back to the series on how to calculate the price of a stock. For part 2, we will be learning about the Gordon Growth Model and how it can be used to calculate the price of stocks with dividends that grow at a constant rate. Let's just jump right into it. With the perpetuity formula approach to calculate stock prices, the crucial assumption is that every period pays the same dollar amount dividend, which is why the perpetuity approach is also known as the zero growth dividend model. Although this may be realistic for firms in stable, mature industries such as breakfast cereals, tobacco, and household appliances, many firms will experience steady growth, and with higher earnings, these firms may pay increasingly more with each dividend. If the value of the dividends keeps growing, how can we calculate the price of this stock without having to individually discount each dividend back to today? The Gordon Growth Model allows us to do just that for firms that raise the size of each dividend at a constant rate, and there are two versions of the Gordon Growth Model. With the ex-dividend.
so here in this model, we consider that, as we know, that the company grow with the company's profit is different for the different years. So that model consider that the company is paying the different dividend in the different years, because we know that the company, it is not possible that company is having the same profit every year, because we know that the market conditions differs each and every year. Their pricings, the competitors Okay, so when we consider all these factors, okay, we can say the income of the buyers, okay, the taste and preference of the buyers. According to all these factors, the company is earning their profits. As we know that the profit of the organizations, it may increase over a period of time. The company will, we can say, gives you the increased dividend, or in some cases gives you the decreased dividend every year. But your dividend is different for the different years. Okay, so this is the concept. So the first year you receive the dividend D1, in second year you will receive the dividend D2, in third year is receive the dividend D3. Okay, so in bonds, whenever we receive the coupon payments, the value is same. That coupon payments is the same. That is in previous example we take, that is the 95 rupees per year is my coupon payments that as the investor I receive. But here it is not in case of the we can say in case of the dividends. The dividend is different, is based on actually the profit earning of the organization of the company. The company generates the different profits, then you will receive the different dividends. So how we tackle the effect of this different dividend payment? Okay, so that we are going to understand.
Formula, the price of the stock with growing dividends is equal to D1 divided by RE minus G, where D1 is the amount of next period's dividends, G is the constant growth rate of the dividends, and RE is still the appropriate discount rate that reflects the riskiness of the firm's equity relative to the rest of the stock market. The cum dividend formula calculates the price of the stock with growing dividends by equating it to D0 times 1 plus RE divided by RE minus G, where D0 is the amount of this period's dividends that we, as the investor, anticipate on receiving. Note that the X and cum dividend formulas are two sides of the same coin.
Okay, so in the M divided formula, that is we tackles these different dividends payments. So we consider that the dividend is growth at some we can say at the constant growth rate, the dividend increases every year. So we consider the 0 in bracket 1 plus RE. So RE is the, we can say, the rate of growth in the dividend uh, divided by RE minus G. So G is the growth rate of the organizations or the company, that we can say.
Being that they both help us to calculate the price of a stock with a constant dividend growth rate. However, choosing between applying the X dividend formula versus the cum dividend formula depends on the scenario. The X dividend formula is used to calculate the price of a stock that just paid a dividend, and thus the numerator uses D1 to reflect next period's dividend. On the other hand, the cum dividend formula is used to calculate the price of a stock that has yet to be paid, and thus the numerator uses D0 to reflect this period's dividend that we are anticipating to receive. In both the X and cum dividend formulas, each consecutive dividend gets smaller in today's terms, as it is divided by the period rate. Yet, each term is also experiencing growth, so that it is multiplied by the growth rate G. We can anticipate that because these dividends are growing, the price of the stock will be greater than the price of a stock that didn't grow, and we can also see that this makes sense mathematically, since subtracting G in the denominator increases the present value, since we are dividing by a smaller number. Please check out part 2 to this video, where we will be going over how the Gordon growth formula is derived and further exploring the X and cum dividend variations of the Gordon growth model. In finance, we have learned that there are many synonyms for the cost of capital that all mean the same thing, such as the discount rate, the rate of return, and so on. Thus, you can also think of RE, the cost of capital, as the expected return from investing in stocks. This becomes clear when the X dividend formula is rearranged to isolate RE, and we can see that RE is equal to D1 over P plus G, where D1 over P represents the dividend yield, which is the return on investment the investor can expect to earn from buying the stock today at price P, and G is the constant future growth rate of the dividends. In short, RE, the cost of capital, is also the expected rate of return on stocks, because RE reflects the two ways in which a stockholder can earn returns on investing in stocks. First, from the dividend, as reflected in the dividend yield, and second, from capital gains, as reflected in the growth rate of the dividends, which captures the increasing value of the company. Let's practice using the Gordon Growth Model. Please read the following practice scenario and pause the video and try using the Gordon Growth Model to calculate the price of Nike yourself. Let's summarize the information we have. Right off the bat, we know that we will be applying the ex-dividend version of the Gordon Growth Model, as Michael just missed the annual dividend that was paid this morning, and so he is interested in the cash flows starting with next year's dividend. The problem clearly gives us RE equal to 11% and G equal to 8%. We also know that a dividend of $2 per share was paid today, but in order to apply the Gordon Growth Model, we need to know the dividend that is paid next year. This is not a problem, as we know that the dividend paid next year will be 8% greater than the dividend that was just paid today. Thus, D1 is equal to $2.16. In other words, if Michael decides to buy Nike stock today, then he can expect that the first dividend he will receive will be $2.16 a year from now. By plugging the values for D1, RE, and G into the ex-dividend formula, we can calculate that the price of Nike stock is $72.
So actually the practical example, if you read if you understand what is given in the example, how we calculate the price of the product by using this, we can say the Gordon growth model. Also here is given is the current market price for the um, Nike share is the $81, okay, and the annual dividend payment is the we can say the 2% per share. And based upon the financial data, the effective annual discount rate for the Nike equity is the 11%, and the dividend will grow at the rate of 8%. That means every year the dividend we will receive on that investment, we will receive the 8% growth. Okay. So this is by using all the given information, we can calculate the present value of the shares by using the we can say the same uh, dividend formula, that is the D0 in bracket 1 plus G. That means today's dividend is the 2 rupees. And what is the growth rate of the dividend? 8%. That is means if you put that formula, value of the formula, that is the $2 in bracket 1 plus 0.08. 0.08, we take this rate, that is the dividend growth rate, that is the 8%. So we write here 1 plus 0.08, so we'll get the value of 1.08. So 2 into in bracket 2 into 1.08, we get the value of 2.16. Okay, so how we we'll put this value. So RE is already given, that is the discount rate is 11%. So 0.11 minus that growth rate of the dividend, that is 0.08. So 2.16 divided by 0.03 will get the value of this 72 rupees. That means when we calculate the present value of the shares, that shows us that the present value of the shares is the 72 only, and the market prices in market, the current prices of that share is the 81 rupees. That means this market value is more than the actual price of the shares. That means we'll not going to buy the shares, because it is the manipulative price of the shares. Because we know we calculate by using the formula, the actual value of the share is the 72 rupees. That means um, uh, we can say the value of the shares in the market should be 72 rupees, but because of some manipulation in the market, the current market price of the share is the 81 dollar. Okay, so that's why we not go with this investment. Okay.
Michael realizes that the value of a Nike share is actually less than the market price of $81, and thus you recommend to Michael that he shouldn't invest in Nike stock. Just don't do it. Now, what would happen if Nike's dividends were instead expected to grow at 0%? This means that all the future dividends would remain at the same value of $2 per share that was paid today. If we plug g equals 0 into the formula, we can see that we would be left with the perpetuity formula that we learned about at the beginning of this video. It may seem like black magic, but these formulas are all related because, at the end of the day, these formulas are all pricing the present value of a stream of future dividends. This brings us to the end of part 2. The key takeaway from
Okay, so uh, we understand the Gordon growth model. By using this model, how we calculate the value of the shares. Okay, so in next type, we'll understand how by using the dividend discount rate, how we calculate the value of the shares.
In this video, we will be performing a valuation of Intel stock price using the dividend discount model. And we're going to be using actual real quarterly dividend information. And I got all of this information by going to Yahoo Finance, typing in INTC, going to the historical data tab, and then changing this to dividends only and selecting the time range that I'm interested in. And then I just took all of these dividends for each of these dates and put them into Excel. So now we have the quarterly dividends for the last 8 years for Intel. And we want to annualize these, so we'll just take the value of each quarterly dividend and multiply it by 4. And then I'm going to hit Control C on my keyboard and paste the formulas all the way down. And then we need to find what's the growth rate of the dividends for each year. So we'll just take the price of each, or the annual dividends for each year, subtract the annual dividends from the previous year, and then divide by the annual dividends of the previous year. And this gives us the growth rate for that year. And then we can paste the formula all the way to the second last one. And now you can see we actually have 8 years of growth rates. And in order to find the price using the dividend discount model, we need to find a growth rate to use in the model. And for this one, we'll just use the average growth rate over the last 8 years. And we'll just be making the assumption that the dividends will grow at the same rate as they have in the past. Okay, I mean, it's a big assumption, but that's one we're going to go with for now. And then we need to use a required rate of return based on what our assessment is for the risk of the company. And we can just start off by saying, let's go with 9%, but in a real valuation, you would want to put a lot more thought into the required rate of return. And then we'll put in the actual price of this stock, which is at this time is about $45.71. Now to calculate the price using the dividend discount model, we'll just use this formula right here, which equals the dividend for next year. And since I'm doing this towards the start of 22, the dividends that are expected to be paid out in 2022 are this $1.46 value. Then we'll divide by the required return, which is this R value, subtracted by the growth. And this gives us a price of $53.07. And we can say that if this price is greater than this price, the actual price, then this is an undervalued stock that we're interested in purchasing. If not, then it's overvalued. And so now we'll see we have a green undervalued mark. But what if we change this required rate of return to 10%? We say this is actually more risky than we initially thought. Now the dividend discount price is $38.92, which is less than this actual price. But one thing that we could actually use this model for is to find out, what do the investors in the market actually require for a return? So what could we make the required return that would make the actual price equal the dividend discount model price? So to do that, we can go to data and then solver, and then we'll just grab this value here, the dividend discount price, and we want to say that we want a value of 45 make the required
So in this model, we actually here, if you see what he did, he actually uh, get the data of the annual dividends. Okay, by we can say we can get all these information in the financials. We can see in financial informations in annual reports of the company, annual reports of the organizations. We know the and what is the annual dividends. So once we know what is the annual dividends, we can calculate the growth rate. Okay, so and we have the formula based upon this dividend discount model. That is the actual price or the value of the stocks is equal to D1, that is the dividend divided by R minus G. Okay, and by using this formula, he actually calculates the average growth rates for that particular time period. Okay, so first he calculate the growth rate in for the individual quarter, and then he calculate the average growth rate. Okay, and what is the expected return of the investors? Okay, as an investor, what is my expectations? What rate of return I want? So he takes the 10%. Okay, and we see what is the actual prices, what is the actual market price of that shares into the market. Okay, so that we already go in the market only. We actually see that on what prices the share is actually we can say traded. But by using this DAM model, by using this formula, that is the D1 divided by R minus G. Okay, so the actual market price is the 45.71. Okay, but if the EVM price, we can say, we'll get the, we can say, here he get the 38.92. Okay, and the market prices are, we can say, 45. That means this, if the actual prices, that is the market prices, are greater than the greater than the DEM prices. That means the prices of the share we calculated by using this dividend discount model. Then we called as the overvalued, because so we can say that these value of the shares in the market will be manipulated by some of the factors. Okay, and if the DEM price is greater than the actual market price of the shares, then we called it as the undervalued. Okay, because of some manipulation, that means your DM price and the actual price of the shares into the market must be near to each other. So then and then only we called it as the fair value for that shares into the market.
return that would make the actual price equal the dividend discount model price. So to do that, we can go to data and then solver, and then we'll just grab this value here, the dividend discount price, and we want to say that we want a value of 45.71 because that's the value of the actual price. And we're going to achieve that value by changing the required rate of return, which is in cell H3. So if we hit solve, okay, then we find that a required rate of return of 9.443% is the actual required rate of return that makes this dividend discount model price equal to the actual price. And so this might actually be closer to the required rate of return that real investors in the actual stock market are requiring when they purchase Intel Corporation. If you'd like to play around with the spreadsheet, click the automatic download link in the description. And I really appreciate
So here, how he adjusts the DM prices is equal to the actual prices. Uh, he calculate the, we can say, the exact required rate of return, so that if we consider the required rate of return is, we can say, the 10, then what he gets the value of the DM price is 38.92. Okay, which is less than the actual price. So at that point of time, the we can say it is the overvalued share. Okay, if he takes the required rate of return 9, so then the DM price is DDM, that is the dividend discount model price, is the 35.07, and the actual market price is the 45.71. Okay, so we can say what we want the actual prices and the TDM prices near to each other. So we want the exact. So then and then only the value of the shares, we can say it's the fair value of the shares. Okay. So then he calculate in between. Now he got to know that the required return, we can say in between the 9 to 10, he need to calculate the exact value of the rate of return, so that the DDM prices and the actual prices of the shares into the market will be same prices. That is, we can see the fair value for that shares. Okay, so he'll do, and he gets the value of the 9.443 required rate of return. So at that required rate of return, so your actual price of the shares into the actual value of the shares into the market, and the TDM prices, that is the by the dividend discount model, the value of the shares will be a same value. Okay, so this is how we calculate the value of the shares by using the different methods. Okay. Now we also have the another method. Okay, just a second. You will understand this. That is the multiplier model. Okay, so this is the last method to calculate the value of the shares.
Guys,
This third.
today we're going to be going over step by step how to use the multiples valuation method to find the intrinsic value of a company. If you'd like to be able to download this multiple valuations model, then you can head to my Patreon page at the link in the description. So that being said, let's jump into the video. Okay, so let's say that for this scenario, we have a new big tech company and we want to try to find the intrinsic value of this company using a price to earnings multiple. The very first thing we would need to do is decide on a few companies that we think are similar to this tech company that we can compare. So let's go ahead and take companies like Facebook, we'll take Apple, we can take Google, and we can take Microsoft. And I'll hit enter, and you can see I've gone ahead and coded this to where some of this data will come up. And in order to find the price to earnings multiple for each of these companies, we need the stock price and their earnings per share. This is very easy data to pull up, but I've gone ahead and used the Google Finance function to automate that process. So if we come over here, to find the price to earnings multiple, we're going to take the stock price and we are going to divide it by the earnings per share and hit enter.
Yeah, actually, he takes the for the four different companies, that is the Facebook, Apple, Google, and Microsoft. He takes the current stock price of that shares of that particular company, and the earning per share, that is the what the dividend we received on each of the shares for the different companies. That is, for Facebook it is the $13.90, for Apple it is the $5.61, for Google it is the $103.83, and for Microsoft 8.95. So and then he calculate the PIE multiplus, that is the PIE ratio.
I'll go ahead and autofill this. And now you can see we have the price to earnings multiple for each of these companies. So the next step is we'll come down here and we want to average all of these price to earnings multiples. So I'll do the equal sign and we will use the average formula. And I'm going to take all of this data here and highlight this and hit enter. And so now we have our average price to earnings multiple. This is what we'll use to value our new tech company. So the next thing we need to do is for our new tech company, we need to find what their earnings per share. For this scenario, I'm just going to make it up. Let's say their earnings per share was about $25. The very next step we'll need to take is we will come here and we will do an equal sign and we will take our average price to earnings. and we will then multiply it by our earnings per share and hit enter. And you can see based off of this data, we were able to find an intrinsic value of $737. And one of the things that's important to remember is sometimes it's better to take the median price to earnings. So for that, I would just do equals, type out median.
So what he did, he actually calculated the PIE for the different tech companies, and then he calculated the average PIE. And for this new tech company on which we can say he accept the earning per share, what is the his expectations that the earning per share in the new tech company is the $25 per shares. Okay, so by multiplying this average PE, that is the uh, that is we can say the profit earning ratio into the earning per share, he'll get the we can say the value of the shares for the new tech company. Okay, so this is how we calculate the price of the shares for the new tech company, or the value of the shares for the new tech company. That means by using the PIE ratio of the different tech companies, that means in any particular industry, the company or the organizations mm, work in the same industry. So by analyzing the different we can say the value of the earning per share of the other organizations, other companies, we can calculate the value of the shares for the other companies in the same industry. So this is how the PIE models calculate the value of the shares. Okay, if we have any query or questions, we will get in the next sessions. It's already the 7 a.m. So you can join the your other sessions. So thank you guys. You can leave now.